Hey everyone, hope you're doing well. This is Drew Creekmer. I'm here with John Creekmer, our founder and chief financial advisor. And today we're going to be talking about some more current events. We're going to call them the Four Horsemen. And John's maybe talked about this with a few of you, but it's a really relevant just catch up for where we are today. And so before we hop into that, John, how you doing today?
I'm doing better today. I had a bit of a flu earlier in the week, and so my voice, if it starts fading or getting hoarse, just know that I'm still recovering from that. So it's interesting. It got a lot colder in Illinois over the last week. I think that actually helps as far as recovering from a
It's
cold.
true. Yeah.
But that's a good thing. Otherwise, man, doing awesome. Looking forward to next week. We coming up on Thursday is Turkey Day,
Yep.
Thanksgiving, and it's just a wonderful time of year. It's actually my favorite holiday throughout the year.
So, what is your plan on the meat side? Because I know this is a big debate every year. Do you do the
Yeah,
deep fried? What's your game plan for next week?
The last couple of years we had a big contest where one person brought a deep fried turkey, one person did a baked turkey, and then I did or oven roasted, and then I did a smoked turkey. And we did a this contest, and I got third place in all 3 years. So
Ooh.
I'm now going off of that one, and so this year I'm actually getting a pork loin and going to be filleting it, and then we're going to stuff it with dressing and cranberries, and then I'm going to tie it tight, wrap it in bacon, and then put it on the smoker for 3.5 hours. So we'll see how it turns out.
Yeah, my arteries are already slightly clogged just hearing about that.
Anything with bacon is good, right?
Oh, it's good stuff. So looking forward to that. That's an awesome time just to get together with everyone next week. So, John, let's kind of hop into this here. We foreshadowed a little bit. There's four items that you've identified as really key things for us to keep in mind as we move here towards the end of the year of what's been a rough year in markets, in the economy. These are really four key data points or ideas that you want us to key in on. So why don't you lay that out for us?
Yeah. So over the last 2 months, been watching as things have materialized, and some of you have heard me and Drew speak about something called a triple bottom. And so we actually a triple bottom. So think about the market whenever it kind of goes to a high point and then it drops back down, it hits a bottom. But then after it hits the bottom, it usually bounces back up and then it retests the low again. That's called a double bottom, and we see that historically over the course of any market cycle. And but we had a very unusual thing happen in which the market actually hit a low point, and then 3 weeks later it bounced up and then hit the low point again. And then within a week, it went up and came back down, hit the exact same low point, and did not breach and break through that low point. So, on technical terms, that's called a triple bottom. And the vast majority of the time, it's only happened, I think, one time the last 100 years, this has not happened. And so, after a triple bottom, very high probability the market actually moves higher and reclaims the 100-day moving average. And so we're still about 7 percentage points away from that 100-day moving average. And so after we saw the triple bottom, we started to identify really four areas to keep your eyes on that will be coming up within a month. And we've kind of gone through those four areas. So the first one is earnings of companies. And we know ultimately the stock market moves based upon the earnings and future earnings of companies. And we felt we were in an oversold position overall in the market. People took the negative news and extrapolated out to the worst possible scenario. And so, with that, earnings actually across the board, except for the name of large technology companies whose revenues were really dependent upon either retail or advertising revenue, we saw the vast majority of other companies actually outperformed on the upside, both in sales and in earnings. So that's the first horse that we're looking at. And so that one turned out well. We do know Nvidia had a weaker earnings report come out this last week, but across the board, still very positive. The second thing we were looking at was the Federal Reserve meeting on November the 3rd,
Right.
and came out and had a general statement of, hey, we're still going to go after inflation. However, we're seeing some things that show that we'll be maybe pivoting. So that was the key word that was thrown in, a pivot. And that means that we're going to still continue to raise interest rates, but probably not at the pace that we have been going, which we've had it seems like subsequent
Right.
0.75% increases,
Fastest in history increase. I mean,
right?
it's been
Fastest in
incredible to
history.
see.
That's caused a lot of real volatility in the stock market. Whenever we're seeing them doing that, you can tie the market volatility straight to those drastic increases. So they made that move, which we kind of that both those two things aligned with what we thought. The third move was actually the midterm election, and we've said all along the markets neither like Republicans or Democrats better. what the market's like is stability in
Yeah.
policies where we don't see drastic swings. And so the market had priced in into some form of a split of power in Washington. And pretty much everybody thought that we were going to see the House turn over to the Republicans, and then also the Senate possibly turn over to the Republicans. Where things stand right now, it is 50 Democrats and 49 Republicans in the Senate, and we have a runoff on December the 6th. And so, at the worst case, it's going to be 51-49. I say worst, but in one scenario, it's 51-49 or 50-50 with
Right.
a tie casting vote belonging to the Vice President Harris. The House looks like it's going to go to the Republican side. There's still 5 seats that are left undecided. Right now, the House Republicans have 218, which gives them the majority at least by one.
Yeah.
And so they may have a 2 or 3 seat majority when it's all said and done. And so that's actually viewed as a positive that we have a Democrat in charge of the White House, and then either Republicans in charge of the House, and then possibly Democrats in charge of the Senate right now. So that split actually worked in favor. The fourth one we were looking at was actually the CPI information, Consumer Price Index on
Yeah.
inflation. And one of the things we're looking for is all the volatility this year has actually come from Federal Reserve increasing interest rates to knock down the inflation rate. And the CPI number came out 2 weeks ago, and it actually showed even though it's still high as far as inflation, the core numbers actually slowed down. So the momentum is slowing down. And then producer price index also came in with a
Right.
better number than expected. So that means that inflation rates are starting to actually slow down on momentum. And so those are very positive. So, Drew, those are the 4 things we were looking at. Things played out the way that we thought, and
Yeah.
it really benefited our clients based on how we have dollars invested currently.
Yeah. So let's talk about how we have dollars invested right now. We had a rebalance first week in November, so you all should have received an email from your advisor just walking through the last quarter and then where we're positioning going forward. But John, let's provide now, we're about 2 weeks in. We have those 4 horsemen that have happened the last 2 weeks. Where do we stand today in our core equity ETF portfolio?
Yeah, so we executed a rebalance on November the 4th. And as you all know, just from the way we manage money, really we're looking at relative strength on a quarterly basis. And so we have invested in oil, natural gas, community banks, broad-based deep value, and then also a short maturity corporate credit. And those were the 4 of the 5 highest rated relative strength there at the end of the quarter, November the 4th. And right now, 4 of those 5 are still listed as far as the highest relative strength. Since August the 4th, it's interesting, Drew, natural gas has been up 19%. From our purchase, the FXN, the oil index is up 20% thereabouts
Yeah.
since that purchase price on August the 4th. And so we're seeing strong momentum to the upside. To keep in mind, folks, relative strength doesn't always move in a straight line. Sometimes it takes 3 steps forward, 1 step back. But we're still seeing both the technical and also the fundamental. So 2 different ways we track things. Technical deals with the total price movement, whereas fundamental is the logical reasons why. And so when you think about it, we do have a constriction in supply within the system, both in oil and natural gas, which is brought about by current U.S. policy, political policy, and then also the war over in Ukraine with Russia. That's caused a supply issue. And then on top of it, then we have demand continuing to increase, both from logistics, travel, consumer discretionary, and then also as far as heading into winter heating months in the northern hemisphere. So, with that being said, we look for those areas to continue to do well. Community banks do extremely well in this environment. It's actually the best performing of the 5 sectors over the last 2 weeks. Deep values perform extremely well. So we look for those to continue on. As we're looking on for the next things we're seeing come down the pipeline, which really all eyes, Drew, right now is just on inflation. And
Yep.
really the midterms are behind us. Not much policy will get passed here by the end of the year. And so all eyes, because of that, are on inflation and what the Federal Reserve is going to be doing on December 14th.
Yep. And it sounds like on December 14th, the expectation is a 0.5 percentage point increase. And we should have some more direction from the Federal Reserve as to what they're going to do going forward. So we'll provide updates as things continue to happen, especially with CPI inflation and interest rates. Now, John, one of the things that we are talking with all of our advisors and subsequently all of our clients about are what are some things that you can be doing to get your easy money or your lazy money working for you. And so there's three areas we've identified that with interest rates moving up have become much more attractive. In the past, these were not tools or areas that we would have necessarily recommended because the earning potential was so low. But now with rates up as where they are, we have three key areas that we want to make sure all of you are aware of and that you all have the information on. So John, can you kind of start with number one there and work down the list for us?
Yeah, so the first one really is short-term treasuries. And so as you guys know, this year on the U.S. aggregate bond index is down 16 to 17% year to date. So if you were a bond investor starting earlier this year, you had significant losses there as interest rates have increased both on the corporate side, the municipal side, and also on the treasury side. So because of that, we're saying, well, we're starting to see a shift. We see a pivoting phrase coming from the Federal Reserve. Interest rates in the short term have actually increased much faster than on the long term side. And so right now, if you have lazy money, money sitting in the savings accounts, the money market accounts at the bank, those rates have not risen as fast as treasury rates. And right now, Drew, I just pulled up a sheet. We're seeing stuff that's 3 months out to about 7 months on treasuries paying between a 4.55 and a 4.7% on U.S. Treasuries. Those are liquid, very short-term maturity. Drew, we're seeing folks going in and laddering right now, a 3-month, a 6-month, a 9-month, a 12-month, or a 6-month, 12-month, 18 and 24-month, and securing themselves upper 4% yield over that period of time. And so for safety money, that's a great place to go.
Yeah, for sure. And with that Federal Reserve increase, we're going to be probably close, if not over 5% after the middle of December. So, that's definitely an area we would tell you, talk to your advisor if you haven't. We have two more areas as well. We've talked about quite a bit. We have a high yield FDIC insured money market account that right now is paying 3.41%. It has FDIC insurance up to $25 million per Social Security number on account. It's fully liquid, no fees. It's just a much better alternative for your emergency funds than what you're going to find at pretty much 9.5 out of 10 banks anywhere in the country. And so anytime interest rates go up about the next week, we see an increase in the interest that's being paid on that high yield money market. And so that's a very easy application. McKinsey will actually add the application here. You can go online and apply and link your bank account by clicking the link here in the video. Now, John, the other thing that we have, it's structured products. And, this is an area that maybe is not right for everyone, right? It's situational. However, with rates moving up, structured products that protect your principal have become much more attractive because you're getting a much higher fixed rate that's guaranteed to be paid out. And your participation in the broader indexes like the S&P 500 or the NASDAQ are much higher. And so what is a structured product? Just a high-level overview of just the current space that we are seeing with structured products.
Yeah, so structured products really come in a couple forms. And so the first of which would end up being what's called a structured note, which is issued by major banks around the world. And what we do is at Creamer Wealth, we focus on banks that are really domiciled here in the United States. We go to them and say, hey, here's what we're looking for. We need a maturity of X. And we're always typically looking somewhere between, I'm going to say 12 and 24 months in our maturities. And we tell them we want to have a certain interest rate. Or in other words, what is our monthly dividend we're able to get from the note as far as an interest paid to you as an investor? And then also, what is the interest rate based upon? And so when we look at the structured notes, we base our interest rates usually on an index, the S&P 500, the NASDAQ, or the Russell 2000. It's issued by a bank, and then they guarantee us, the bank guarantees us, so it's not FDIC insured, but it's coming from the bank and how strong they are from a credit standpoint. And so they're guaranteeing us a principal return, and then also a certain yield that we'll receive as far as from a dividend if we want an income note, or a potential sharing in the upside potential inside the underlying index, the S&P 500. And so we're seeing that as a phenomenal way to have some upside growth potential, but at the same time limiting our downside potential if the market happens to go negative. Right now with interest rates moving up, they actually have better pricing potential. And so we're seeing some really phenomenal yields coming into clients. And through some of the most recent ones are the 6.5% to 7%, I believe, as far as what a monthly dividend.
I just got pricing on one at 7.5% a year for 2 years. I mean, that's pretty phenomenal.
Yeah,
to lock that in.
So we want to make sure we're diversified there and with different banks and that we're structured properly. But if you're looking to increase some dividend yield, getting 7.5% is a phenomenal thing to use. The other structured product that we do use, that we've seen actually clients really gravitating toward recently in the last 3 years, is the usage of what's called a fixed indexed annuity. And right now we have a 5 year through Lincoln National, which is one of the highest rated insurance companies in the country, been around for over 100 years. And I'm not sure the exact rates on that, but it pays a phenomenal fixed interest rate. Plus, you can also participate in the S&P 500, and you have no stock market potential of loss in the account. So
Yeah.
we're seeing folks right now, if the market's down, is a great time to be looking at a product like that.
Yeah, for sure. For sure. On that Lincoln, it's 5% is the current fixed rate. And then on some long, I mean, that's pretty phenomenal as well, for no market risk at all. And so what we would tell you to do is, hey, there's 3 areas that you can definitely get some money at work, earn a much better rate of return than what you're going to find at the bank, but also have some security as well in your principal investment. And so we would tell you, if you haven't already had a conversation about any of these products with your advisor, reach out to them, schedule a 15-minute strategy call. Just say, hey, I got X number of dollars in my bank account. What are my options? And they will walk through that with you, and we'll make sure that we have the right fit for you. So, John, as we head out here, going into Turkey Week, end of the year, what are some final thoughts for us?
I'll tell you, we have so much to be thankful for, and so many blessings in life and relationships, and with all of you, folks that have put so much trust in us to give you quality information so you make wise decisions to accomplish your life goals. And over the course of the next week, I'd encourage everyone just have your mind on that spirit of gratitude, spirit of Thanksgiving, and just enjoy time with friends and family as you're out and about celebrating the holidays.
Yep. Absolutely love that. Thanks, guys. Hope you found this helpful. If you have any questions, reach out to us. We'd love to chat with you. But enjoy next week, and we'll talk to you all soon.